Well, it's been a tough year for tech so far, starting with downgrades on Apple stock as analysts become concerned with the tech giant's iPhone sales. Then we heard from their rival Samsung, who warned of a 35% plunge in profits in its fourth quarter. Now layoffs at Google and Amazon. Should investors be worried about the sector? We've got Brian Belski, BMO Capital Markets Chief Investment Strategist. So should investors be worried at this juncture? I mean, we're only 11 days into the calendar year here.
Yeah, let's just breathe a little bit. By the way, you know, the Smiths were a great band in the 80s. I'm aging myself, but have you heard that joke before, or no?
No, that hasn't. Not live on TV, but yeah. You know, and Brad plays the drums, so maybe.
So there you go.
You can take after them in the future.
No, you know, there's a lot of different calls out there on tech, and you know, our work shows that, especially after the type of unbelievable performance we saw in 2022 on the downside and then unbelievable performance on the upside, you have to take a look at 2-year periods. And following 2-year periods like this that we've seen in technology since the great tech bubble, okay, typically and historically, the 80% of the time the next year we see positive returns. That's number one. But I think the most important thing that you talk about all the time on air is valuation. And we have found through our work that valuation, actually in technology especially, is a terrible predictor of future results. And in fact, we believe if you take a look at all parts of the financial statement, so balance sheets, cash flow, income statement, we've already seen a bit of a pullback in valuations, and tech is not stretched, and we're nowhere near any kind of bubble or froth.
That valuation point that you just made, is that tech specific, or do you also see that in other areas, other sectors of the market? In terms of it not being the best indicator?
Yeah, well, traditionally, it is not a very good indicator at all, especially for the stock market. Now, over a 5 to 10 year frame, yes, but over a 1 to 2 year frame, I mean, come on, we're talking about 11 days right now in the market, and we in this, you know, we have the attention spans of gnats in terms of investors right now. We have no holding period, so analysis. So when we take a look at a stock, an industry, a sector, in a portfolio that we run, we have the great fortune of running 12 for BMO, is that we look for 12 or 18 months, and we look positionally. So Apple, everyone likes to beat up Apple. Guess what I've learned? You buy Apple when it goes down. You talked about Google and Amazon cutting costs. That's exactly when you want to buy stocks, when they cut costs. There's been financial companies in 2023 that cut a lot of people, paid a lot of people down on Wall Street, cutting costs. That's exactly when you want to buy the banks. So you want to buy companies when they get, quote unquote, religion become tighter with respect to how they're running their businesses.
When we think of some of the S&P 500 targets that we've heard for year end, how much of that will be driven by tech, or is there another sector that you believe is going to emerge as that leader?
Well, every year I try to sneak something through compliance on my year ahead piece. And this year, when we talk about size and style, the heading is Everybody Love Everybody. Okay, Jackie Moon. And if you know your semi-pro pop culture.
Will Ferrell?
Yeah, exactly. So that guy. Anyway, you want to own a little bit of everything.
Yeah.
Okay. So what does that mean? From a sector perspective, you want to own tech and financials. Tech's growth, financial is the contrarian value side of things, okay? Everybody hates the banks, they're believing they're going to zero. Now everybody thinks tech is over. So I think you need to be in value, you need to be in growth, you need to be in dividend growth, you need to be in small cap. Small cap holders, and we've been bulls on small cap now for a long time, now everybody's kind of coming around with us, but small caps, if you take a look at the entire small mid-cap universe, it equates to the total market cap of Apple. Isn't that amazing?
It is amazing.
Think about that. That's perspective.
Yeah. And puts everything in perspective. It also puts in perspective the moves that we've seen, the excitement that we've seen around the market. But Brent, when we talk about, you mentioned financials in there. Everyone loves to hate on financials.
Oh, yeah.
We got to bring up the Citi news that we did get out last night. Don't want to make too much of one headline or one update from one of the larger banks, but the billions that they have announced here, just in terms of reserves, in terms of the cost cuts that they see going forward here, does that at all change your thesis? Probably not, just about the larger financial sector? And I guess when you take a look at a headline like that, put that into context for our viewers.
No, because typically and historically, when banks over-reserve, they traditionally are too conservative at the wrong time. They should have been conservative maybe a year ago. And now we've seen massive restructuring in Citi, new management. That's exactly what you want to see. And from an institutional perspective as well, you know, we own JP Morgan in some dividend growth portfolios, but we switched a lot of our JP Morgan into Citi because I think that JP Morgan has to absolutely nail its results, because everybody's kind of counting on that stock, where Citi, people are like, nah, well, you know, I don't really know, and not a lot of institutional sponsorship in Citi. So I think that Citi is more of a contrarian name here.
So with that much Goldilocks that's in the tape right now, then what should investors be bracing for at this point?
Well, I think, you know, you started off this right at the end of the hour, talking about politics. I think politics are going to cause some volatility, especially the first half of the year as we kind of follow through with the caucuses and the primaries. Some reactionary, maybe think of it as a mini 2016. Remember 2016 was very volatile. We had Brexit.
Yeah.
Everybody thought that was very bad. And then we had the election, which was a flip-flop. And so I think we're going to have some volatility in that, but I think the second half of the year could be a lot better, because what we're seeing in our work, that earnings are going to be really good. Remember, a year ago nobody believed in earnings and they beat everybody. Now again, this year it's like, oh, the expectations are too high. No, actually, from a revision standpoint, we're seeing revisions start to come in, and the earnings expectations, especially for the areas that I think are going to drive the market, which was part of your question, technology, and financials, but don't discount the consumer. Consumers still doing great in areas like communication services with respect to the Googles and the Netflixes still have a lot of earnings power.
All right, Brian Belski, always great to have you, especially when you're here in studio. Thanks so much for stopping by. We'll talk to you again soon.